Hello, investors, and a happy Friday to you. Colby the DGI Crab is here once again to do another Friday video where I examine each of the stocks in the four tiers to see where the value lies. This channel is all about age-themed dividend growth stock investing, where age and time horizon are the most important metric to take into consideration. Plenty of value on the market still, and at the end of this one, I'm going to go through this as quick as I can so we can take a little bit more time to review the DGI Crab Channel portfolio. Now, just as a quick legal disclaimer, I'm not a professional financial advisor, and the content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. For anyone new to the channel, I do quickly go through the DGI Crab strategy, where I put 50% of new money into age-appropriate ETFs for automatic diversification. And among the 60 stocks that this channel focuses on, I'm specifically looking for stocks that are yielding at least 30% or more above their 4-year average yield. My top 10 personal favorite stocks I will add if they're yielding 20% or more above their 4-year average. And I'm going to remain within my age tier or my group of stocks unless there's a stock in a different tier yielding 50% or more above the 4-year average yield, of which there are a couple. And if there's no buyable stocks within my tier on a given week, I will just simply invest more money into ETFs. It's as simple as that. So, as we're building up that passive income, let's take a quick look here at the spreadsheet. We're going to start, as always, with Tier 1. These are super compounders for the 18 to 30-year-old investors, and these are sorted by the valuation tab, where I'm comparing the 4-year average yield to the current day yield. Nike and Nordson still remain the two stocks in the buy zone for the Tier 1 group. Nike is threatening to fall below $70 a share, and I am all here for it, currently yielding more than 2.25%. Even though that 4-year average yield ticked up another basis point this week, Nike remains a great deal. And I'm going to continue to add Nordson until they have a price recovery. Nordson looks very cheap still to me. Tier 2 for the 31 to 41-year-old investors. The starting yield is going to be a little higher in this group, but we're still looking for strong year-over-year dividend growth. Hershey has continued to take an absolute beating. I'm stunned it's sitting down here in the low 150s. But I'm going to keep adding to Hershey as well. I am all about adding Hershey right now. Eventually, cocoa prices are not going to be super inflated or expensive anymore. Hershey will recover. And when the day comes that happens, the bigger my position in Hershey is, the happier I will be. Target has climbed back up into the number 2 position here on this group as they're sitting down here in the low 130s. I'm still all about adding Target, the dividend king with plenty of year-over-year dividend growth. And McCormick and American States Water are sitting here as nice buys as well. Not exciting stocks, but here they are yielding in the mid 2% ranges when their 4-year average. They typically don't even yield as much as 2%. So good solid deals on these two as well. NextEra Energy was a buy briefly, but now has dropped back into the just okay valuation range. I'm going to wait to add any more NextEra Energy. I want to get that back down below 70 a share before that looks like a great add. Still not a bad buy. And then McDonald's fell off a little bit this week. This is one of my top 10 favorite stocks, so if it hits that 20% mark, I do add to McDonald's. It's not quite at that point where I want to start adding more to it right now, but I'm keeping a very close look at McDonald's going into next week. Tier 3 for the 42 to 53-year-old investors, starting yield gets a little bit higher. The year-over-year growth rate gets a little bit lower. This is a nice middle range here where you're adding pretty decent starting yield, but you're still getting good solid year-over-year dividend growth. Archer Daniels Midland remains in that 50% or more undervalued, just like Nike, just like Hershey. I am still adding to Archer Daniels Midland. Hormel down here below $30 still is not finding any room for recovery right now. Still a good stock to add, yielding nearly 4%. If you want to load up on Hormel while they're going through some tough times right now, I think you'll be happy in the next 2 or 3 years when this one recovers and starts doing larger dividend increases, and you started out with a yield in the very high 3%. Pepsi, a top 10 favorite stock of mine, along with Johnson & Johnson, are both still in my personal buy zone. Pepsi at 32% undervalued right now. I am thrilled to continue adding Pepsi, especially under the $150 mark. GPC, Genuine Parts Company, is still a nice buy as well. American Tower, after being in the buy zone the last few weeks here, has recovered a little bit. So I'm going to hit the pause button briefly on American Tower, but if that drops a few more dollars, it'll get right back into that buy zone for me. Tier 4, 54 and older investors, where we're getting high starting yield. Still getting a little bit of year-over-year dividend growth, but these are more yield plays at this point. If you were adding realty income when it was yielding above 6%, you're probably feeling pretty good about that as they've recovered a bit and that yield has dropped pretty comfortably below 6% again. So all of these are back into the just hold category. Verizon continues to kind of flirt with buy zone area, but I'm still not pulling the trigger on any of these necessarily. I'm going to wait for each of them to get cheaper before I start investing in them. Quick swing by my top 10 favorite stock tab, not new stocks. These all are contained somewhere between tiers 1 through 3. Pepsi and J&J firmly in the buy zone. McDonald's getting closer, but still not quite there just yet. The strategy for the week would be as follows. 50% of the money is going into appropriate ETFs. For the younger folks, for the tier 1s, I'm going to be focusing primarily on the S&P 500 while getting some small cap exposure and a little bit of dividend growth, and then paired with non-U.S. stocks. VYMI is my only non-U.S. stock holding, and I do 5% across the board regardless of age tier. Good, strong starting yield, decent dividend growth, stable price. Hard not to like VYMI. Tier 2, same 4 ETFs, slightly different focus with dividend appreciation getting the bulk of the money. S&P 500 and small cap still there, but getting a little bit less. And then for tier 3, SCHD, VYM, DHS make a nice trio of higher dividend yield ETFs with varying strategies. And then for tier 4, I like to go with SPYD for the stock exposure, getting the major market cap stocks in the S&P 500 with really high yield, and then grabbing ETFs that give me exposure to high yield bonds, preferred shares, MLPs, covered calls, and then of course finally our non-US holdings in addition to that. For the stock purchases, if you're a tier 1 investor, the strategy for me would be to put the biggest investment into Nike, with Nordson and Pepsi getting the next largest allocations, and then Johnson & Johnson as a top 10 favorite stock of mine could get some consideration here, as well as Hershey and Archer Daniels Midland, both of which are not within tier 1 but are yielding 50% or more above the 4-year average yield. For the tier 2 investor, a little bit more to choose from here. Hershey would be my primary consideration, while also making sure to add a little into McCormick, AWR, and Target. I'm definitely going to be hitting Pepsi while it is in this price range as a tier 2 investor, and then I'd probably try to grab a little J&J, Nike, and ADM. This is what I did this past week, with one exception to that. I did not put anything into J&J this week because I purchased some NextEra Energy on Monday when it was still in my buy zone. And I'm glad that I did because it recovered. For the tier 3 investor, definitely Pepsi gets the bulk of the focus, with Archer Daniels Midland right behind that. J&J, Hormel, and Genuine Parts Company all getting some attention, with Nike and Hershey optionally getting a little bit of love as well. And then finally, for the tier 4 investor, I'm going to continue doing the ETF double down, just doubling down on my ETF investments and not spending any money on those tier 4 stocks that just aren't quite cheap enough for me right now. I don't double down on the international investment, so I would throw that little extra amount left over into Pepsi. Great deal getting Pepsi where it is at this point in time. Even if you're looking for higher starting yield, I think Pepsi is high enough, and you're still going to get some really nice dividend growth with that one, tier 4 crowd. And the DGI crab portfolio, so this is 100 a week portfolio. It's been going on for a little bit now. The total amount invested, we're up to 1,400 for this portfolio, so not too shabby so far. That portfolio so far has paid out $4.76 worth of dividends, and it is currently yielding $34.75 annually. The largest investment in that right now, because I'm a tier 2 investor for until November of this year, is VIG. So this is going to be the number one thing that I'm invested in this portfolio for the foreseeable future. Hershey is the largest individual stock position for this particular portfolio, up to 285 invested into Hershey after adding another $10 to it this week. S&P 500 is in that third spot, while Pepsi, I've just been doing $10 into Pepsi each and every week while it is in that super buy zone. I'm really happy at these top 4 positions, and then it's pretty even for the next few. Target, the other 2 ETFs here, VBR, VYMI, that get $5 each and every week. Nike, Archer Daniels, Midland, Johnson & Johnson definitely have gotten some exposure to a lot of different companies here. As I said, I put $5 to start a little small position into Next Era Energy. Did that while it was cheap, and that one is actually up in the green because it did have a pretty immediate price recovery. And then, so let's see here. That means that we're sitting here on 15 total positions in the portfolio right now. Only 4 of which have $100 or more invested in them. As I've explained in previous videos, I have no problem having very small positions in a portfolio, assuming that those positions were purchased when the stock was trading really cheaply. Because my primary concern here is the annual dividend income number that all of these positions collectively contribute to. Now, as you get into your retirement age, if you've got a portfolio with quite a few positions in it, 25, 30, maybe even more than that, one strategy you could think to employ would be to gradually start trimming some of the smaller positions out and moving those into either higher yielding investments, or just taking that money and living off of it while keeping the dividend reinvestment on some of the other larger positions so those can continue to grow. There's really no pure right or wrong answer, but for me, if this was a retirement portfolio for me and all of these positions were, say, 100 times larger than they are right now, then I might consider trimming the smaller positions, cleaning it up a little bit, streamlining it, if you will, and living off of those. Or if it was at that point where it was yielding enough that I didn't even have to sell any positions, I was just making enough off of it collectively to live off of the dividends, then once again, I don't necessarily care if I'm getting some smaller payments here and there from some smaller positions. I'm just going to be looking at how much yield am I going to be getting for that particular month, and is that enough to comfortably cover all of my living expenses? And I might hold on to everything forever at that point in time. That's the long-term goal for me anyway. Not to say that I won't ever sell anything if it makes sense, but ETF positions are almost assuredly going to be forever hold positions, and I'll start looking at smaller positions that have lower starting yield as ones to maybe move off of when I am at that point where I can retire. So that's the video for this week, y'all. It's always good to have a plan going into the following week, so I hope you'll take a look at this video or a time or two over the weekend. Devise a plan for yourself and stocks to target. Let me know what you're buying down there in the comments below. And until next time, I'll see you. Have a good weekend, everybody.